एक बार स्टार्ट हो जाए तो आप मुझे बता दीजिए, देन आई विल स्टार्ट.
Now you are live, ma'am.
All right. Thank you, Vinayak. Good evening, everyone. It's a pleasure to have Mr. Chetan Rao here, who is the director in the Foreign Tax and Tax Research Division of Central Board of Direct Taxes. He is currently handling matters relating to tax treaty negotiations and non-transfer pricing map cases. He also has handled two of the arbitration cases involving tax matters initiated under the India-UK VIT. He is also the country delegate to OECD Working Party One Task Force on Digital Economy and part of the Indian team negotiating the two-pillar solution to address the tax challenges arising from digitalization of the economy. He is also the vice chair of Task Force on Digital Economy, a subsidiary body of the Inclusive Framework on Webs. On behalf of CCIT, I welcome you, sir. The floor is yours.
Yeah, thank you, Sana, and thank you for this opportunity to talk to young students of law and all the young people who plan to pursue this profession. And so just briefly starting with the introduction that there's a division in CBDT called the Foreign Tax and Tax Research Division. So it's not that only it's about enforcement or about policy making, but the CBDT also has a dedicated research division, and our division basically deals with all matters relating to foreign taxation, and we have a number of officers, and plus we also deal with treaty negotiations, plus the OECD work, and plus also the exchange of information. So that's the brief introduction of our organization. And so starting with, so in my presentation, because this is about international taxation, so I will just look at what the trends are. The trends, and all these trends which are on the screen will be somewhere placed in whatever discussion that will follow, and also in the slides. So what we are seeing presently is the rise of multilateralism. So earlier, it was more of bilateral treaties because the 1920 was more of a bilateral treaty, and there were certain regional agreements. But now, if you look at it, we have multilateralism in tax transparency. We have multilateralism in how to address the treaty abuse, the tax treaty abuse, and how we have even in terms of how we can tax multinationals. And the second main trend, what we see is in international taxation, is the recognition of demand side factors. Because if you see the transfer pricing and mainly whatever the present profit attribution systems are, they primarily are more supply sided. So now increasingly there's a recognition of demand side factors, and this is also reflected in the way the amount A is of Pillar 1 is designed. Then the third main important trend, if you see, is towards the minimum taxation. So in 1920s, the concern was that there is double taxation. And then the BEPS came. The BEPS was mainly concerned about, if you see, double non-taxation. But now we are in a phase where the stress is on minimum taxation. And along with this, there is a drive towards simplification of the existing rules, and especially of the transfer pricing rules. And this is reflected in the amount B, which is also part of the Pillar 1. And all these trends are also accompanied by the fact that now the tax administrations are looking for more formulaic solutions. They want that the rules should be simple and easy to apply, and that is why along with it there's a stress on dispute prevention. And while this is very good, but still everybody does understand, given the complexity of tax legislation, there will be disputes, and thus we need to find out new ways of dispute resolution. Now, when all this is happening, it is very important that the tax administrations have the capacity. So thus there's an increasing stress also on tax capacity building. And in all this, it's very important that information is shared, not only information about the financial information, but now we are moving towards information sharing of crypto. And these are just small steps that are being taken place with the stress on enhanced tax transparency. And last year we saw the UN resolution, and the UN resolution lays a ground for intergovernmental tax body. We have intergovernmental bodies in all areas. We have in trade, we have in customs, and we talk. You name an area, you have an intergovernmental body. But in tax, we don't have any intergovernmental body. Though one might say that there's the inclusive framework on BEPS, which has more than 142 members, but it's not an intergovernmental body. So along with what is happening is that obviously it is increasing complexity. So there are two diametrically opposite things that are happening at the same time. There's a stress on simplicity, simplifying the existing rules, but at the same time, the complexity is also increasing with the new rules coming in because of the very fact that it will take time for the new rules to settle down. And plus, more and more acronyms are being churned out. So you'll have more acronyms to learn and one day we'll be just out of all the acronyms. So that's just an introduction of what lies ahead. So first coming to what is happening in multilateralism. So if we see that the seeds of multilateralism in taxation especially were basically driven by G20. And it is the key driver of what is happening in international taxation, especially in the area of multilateralism. It started with tax transparency first, then it became the BEPS, and now the focus is on how to address the challenges arising out of the digitalization of the economy. And while BEPS, this slide gives a brief overview of the 15 action points of 15 action of the BEPS and also the 4 minimum standards. I won't go into detail on them. This is just for showing everybody that what BEPS was all about, and I hope everybody's aware. And one of the main important action of BEPS was action 1, which is relating to digital economy. During the BEPS negotiations, no conclusion could be reached, no solution could be reached. So this part of the action 1 still carries over and now has resulted in the 2-pillar solution. So my main objective of showing you this slide was that how G20 is driving the multilateralism in international taxation. And this year, as all of you are aware, that India has the G20 Presidency. So these, as part of the Indian G20 Presidency in international taxation, India has 3 main priorities. The first main priority is monitoring the progress of 2-pillar international package, because given the importance of the 2-pillar solution, the Indian presidency is keenly monitoring and nudging it so that a solution is reached. The second is focus on tax and capacity building. As I had also said earlier, that given the fact that new rules are being negotiated and old rules are being simplified, and there's a great need of adaptation to this change. And this change can be only adapted if the tax administrations have the capacity. One example I'd just like to give is that, like, if you see both the pillars, pillar 1, amount A, and pillar 2, they don't start with taxable profits. So they start with financial accounts. So which effectively means that once the system is set in place, there will be a greater need of knowledge of financial accounts. And presently, tax administrations do have the knowledge, but they don't have that kind of knowledge that is needed to deal with these new changes. So this is just one example in which the capacity building of tax administration would have to be worked upon. The third priority of the Indian G20 presidency is enhanced tax transparency. So in this, we are looking of how we can effectively use the existing information and how we can encourage countries which are still not part of the network to join. Second is that the information sharing in financial accounts is already there. Crypto framework is already ready. And now the next part is the immovable property, because that is also one of the areas where the illicit financial flows flow. And so as part of this priority, India is exploring how above a certain of how countries can have such a framework, because countries have different laws. In some countries there are beneficial ownership registers which may be public and some not so public, but in some countries nothing is available. So how we can see that what type of framework can be developed in which something can be done. So it's just an exploratory phase of how this can be explored. And the last priority is because of how information can be shared with the law enforcement agencies. Because under tax treaties, that information can be shared, but that information requires the consent of the country which has provided the information. So that consent at a lot of times takes a lot of time. So, and such information has a timeliness value. So how we can streamline this system? And this is not something which is new. Like in the 2020 Punta del Este agreement, the Latin American countries tried to have a framework. So this is something which is developing on that and going much beyond in the terms of streamlining for all the countries who are interested in this type of sharing of information. So now coming to one of the major parts of the presentation, which is the two-pillar solution. As all of us are aware that the digitalization of economy posed tax challenges which needed to be solved. And one of the main problem was that all the current nexus rules are based on physical presence, and the profit allocations are based on supply side factors. So the moment you have companies which are adopting new digital models, which have significant instances engagement in economies of jurisdiction without physical presence, you need new rules. If you don't have the new rules, then there'll be mismatch between where the profit is generated and where it is taxed. So this was the basic problem that needed to be solved. And a two-pillar solution is exactly addresses these problems, because the existing rules were framed in 1920s. Then there was great stress. Obviously, there was stress on physical presence because everything was brick and mortar. But unlike now, when everything can be done nearly virtually, even you could have never thought about delivering a lecture just virtually, say 10 years back, but now presently we have such facilities. So it's not only that, but it's spread out in all the businesses and in all the economy as a whole. And that is why it's said that you cannot ring fence the digital economy, because one of the reasons is because it's pervasive everywhere. And this is what Pillar 1 tries to address. And in Pillar 2, the focus is to address the remaining BEPS issues, and also to deal with tax competition, where the lowering of tax rates had become a norm, so that to attract companies, and which ultimately led to large-scale profit shifting and distortive tax competition, and resulted in revenue loss to jurisdictions due to profit shifting. So the main aim of Pillar 1 and Pillar 2 are to address these trends in international taxation. So how has the journey been so far? So related to two-pillar solutions, so there'll be the G20 and OECD inclusive framework on BEPS has been working out to find a solution since 2016. That is after the BEPS project was ended. And in 2018, the inclusive framework agreed for a coherent and concurrent review of profit allocation and nexus rules. And the plan was to have a consensus by the end of 2020. And in 2019, the two-pillar approach, the Pillar 1 and Pillar 2 were first time proposed. And then the COVID stuck. but still the blueprint reports on Pillar 1 and Pillar 2 came out. And then due to various factors which are beyond anybody's control, the consensus date was much extended. And finally, the breakthrough came in 2021, which was in July. The inclusive framework issued a statement, and which was further developed in the October statement, which laid down the future work of how Pillar 1 and Pillar 2 will be developed. And more than 137 countries, which represent more than 90% of the global GDP, joined the October statement, supported the October statement for establishing a new framework for international taxation, and also agreed to a detailed implementation plan. So this work is presently outgoing. So now that I have talked about the Pillar 1 and Pillar 2, so this slide is basically of one part of Pillar 1. So Pillar 1 consists of amount A and amount B. So one of the questions that arises is that why are they called amount A, B? So just to give a brief history that as I discussed in the last slide, that when in 2019 the two pillar approach was proposed, there were amount A, B, and C. So there was amount A, which basically deals up with reallocation of taxing rights. Amount B deals with transfer pricing, how to simplify the transfer pricing rules. And amount C was certainty. But as the work progressed, C was dropped. And so now amount A and B and certainty is both part of it. It's like a horizontal work, which is part of the whole of Pillar 1. So I'll come out to it later. So if you see Pillar 1, so Pillar 1 is about, the main part is amount A, which is one of the solutions to addressing the challenges that have arisen from digitalization of economy. And what it talks about is that it recognizes that markets are important and markets should be provided with a share. Now, how do we do it? So it deems that if a company has profitability greater than 10%, so 10% is the line drawing. Below it is deemed to be routine profits, and above 10% is deemed to be residual profit or non-routine profits. So out of this, 25% of this residual profit will be allocated to market jurisdictions. Now, a question can arise: why 25%? Well, 25% is a negotiated percentage. So it doesn't have, as such, you can't really pinpoint that why 25% was reached, but more or less that is a number which is deemed to be that this is the contribution of market in the residual profit. So it's just a number, it's just a negotiated number. And what it does is basically, because the non-routine profit is something which is an extra profit, and this will be allocated to market jurisdictions on the basis of a formula, and that profit allocation key is the revenue that is earned in that country. So Pillar 2 primarily consists of interlinked rules, and one of the major rules in that is the global anti-based erosion rules, which is called also the GLOBE rules. So for GLOBE rules, the model rules, the commentary, and the administrative guidance has already been released. And this work was done by the Working Party 11 of OECD. And so what it really does is that GLOBE assumes that there's a minimum taxation rate of 15%. Again, this 15% was a negotiated, agreed amount, that any company which is not taxed below 15% is a problem. So what Globe Rules does is that it says that any MNE above a certain size, wherever it operates, it has to be taxed at the rate of 15%. And if the tax rate is less than 15%, then the difference between whatever the rate the company is being taxed in a particular country minus 15% would be the top-up tax. So this is a graphic This slide gives the graphic representation of how the globe rules work. So, so coming to what the key aspects of the two-pillar solution are. So in pillar one, there's the amount A, which I had discussed and also shown a graphical representation. And the second important part of pillar one is amount B, which is the simplified and streamlined application of the arm's length principle for in-country baseline marketing and distribution services. And the focus of amount B is especially on the needs of the low capacity countries. I'll come in detail later on in the slides. So if we see from what we see from the trends that I talked in the beginning are all reflected in the pillar one that you see. We talk about simplification. We talk about group taxation. We talk about a formulaic approach. And then we also talk about tax certainty, because one of the aspects of Amount A is that it envisages tax certainty through mandatory and binding dispute resolution. And also there's an elective regime to accommodate certain low capacity countries. And it also talks about stabilization of the economy through removal and standstill of the digital service taxes and similar relevant barriers. So the other part is the pillar two, which pillar two consists of the globe rules and the subject to tax rules. Both of the rules have the same objective. So the globe rules basically say that the MNEs, that all the parts of the MNEs should be taxed at least 15% wherever they operate. So it has a threshold that all the MNEs which are beyond a certain size, which is 750 million euros. And two important aspects are the income inclusion rule. The income inclusion rule is the rule for which I had shown the previous slide. This relates to the income inclusion rule. And the second part of the rule is the undertax profit rule. So earlier it was known as the undertax payment rule, but now it's called the undertax profit rule. And basically what it says that if because this operates at a group level, so if where the country in which the parent entity of the group is there and it does not apply IRR, so the countries in which the other subsidiaries are there can apply an undertax profit rule and take that top-up tax. So during these negotiations, there was a third rule that came out as part of the globe rules, which is the qualified domestic minimum top-up tax. It's not exactly a rule, but it's more of a compromise in the sense that if the countries adopt a minimum taxation is adopted in part of the domestic law, and once this domestic minimum taxation meets the qualified domestic minimum top-up tax guidelines, which are part of the administrative guidelines released this February. So this will be considered as fully creditable against the liabilities of Pillar 2 rules. So this is QDMT is a very important part because earlier, if you see that in Pillar 2, the residence countries would have gained from Pillar 2, especially the globe rules, but now even the countries which have those subsidiaries can adopt the QDMT and increase their revenue. Another very important part of Pillar 2 is also the subject to tax rule. And subject to tax rule is basically, it's a bilateral treaty rule. So what it says is that if two countries have a treaty and the taxing rights of one of the income streams is in the other country, and that country does not exercise its rights, then the other country can take back those rights in the form of secondary rights and can tax that transaction. So it's more of a transactional rule operating in bilateral, and it basically the headline rate that it checks is it applies at a nominal corporate rate of below 9%, and it has a scope. The scope is still under negotiation, but interest, royalties, and a defined set of other payments, which are certain services, are there. So which are also in part of the blueprint. So they are still under negotiations. So they are part of this rule. So coming to how the Pillar 2 will be implemented. So for implementation, Pillar 1, especially Amount A, will be implemented through the multilateral convention. and the multilateral convention is presently under negotiation, and it is expected to be open for signature in 2023 this year, by June or July. And once it is in, apart from MLC, there will be a number of domestic law changes which countries have to do, because convention can be an overarching framework, but ultimately the taxing right is developed from the domestic law only. So, and work for finalization of the model rules that countries can adopt, and also the multilateral convention is there underway. And then the other part, important part, is the pillar 2. And pillar 2, especially the globe rules, the income inclusion rule, the undertax profit rules, they are basically to be implemented as a common approach. And the model rules, commentaries, and administrative guidance have already been finalized and are available in the public domain. And the second part of the pillar 2, which is the subject to tax rule, is still under negotiation, and it will be implemented through a multilateral instrument, and it can also be done bilaterally also. And the October statement has a type of a commitment that a developing country can, if it finds that STTR would apply, it can write to the other country and say that it wants a STTR. The other country is committed to provide an STTR in the treaty. So it can operate through multilateral instrument and also through bilateral. And the scope of the subject to tax rule is still under negotiation and development. So with this, the part of the overview of the two pillar solution is over. So now I'll just touch briefly on the amount A of pillar 1. And the reason I am touching on this is the fact that the next part, which is the dispute resolution, is linked to amount A. So it is important that we understand that how amount A operates. So this is one of the diagrams which show how amount A operates. So there is country A, where the ultimate parent entity is there, and there's country B, which is the market jurisdiction, in which the services are provided virtually. So there is no physical presence. And then there's country C, where there is physical presence in terms of a PE. And there's country D, which has a subsidiary. And then there's a country E, where the company has a presence, but the IP of that company is also located. So that is the entity with residual profits. So amount A applies for all companies which have a turnover over 20 billion euros. So the number of countries, the number of companies that will fall, which are above 20 billion euros, are around 250 to 270. They change depending on the year. And the second condition is that they should have a profitability above 10%. So once you look at the profitability above 10%, there'll be 100 or 110 companies which will be in scope of amount A. And this is, I have given a very simplified way of the turnover and the profit, but there are other conditions also. There's an averaging mechanism that will be allowed, that has also to be applied, but I won't go into those details. And as part of the October statement, that it was also agreed that after 7 years, a review will be conducted. And if it is found that amount A is being successfully being implemented, then this turnover will be reduced to 10 billion euros. So this is a single snapshot of how amount A works. And apart from this, there are a number of building blocks which build up. So these building blocks include the scope, just like what we saw. And once we see the scope, it is also that amount A excludes extractive and regulated financial services. Now the question will arise that why does it exclude that? One of the reasons of exclusion of extractives is that extractives are basically related to locational rent. So which means a country where mining or this extractive activity is done, that has the first right over the revenue that is earned. So if that right is within that country, so it it should not be distributed. So this was the reason for the exclusion of extractives. And coming to regulated financial services, the exclusion is for regulated financial services. So which means financial services that are regulated. So when they are regulated, which means, as we all know, that there are prudential norms for financial services, so which ensure that residual profit is captured where these companies are working. So this is part of scope. Then once we have the companies which are scope, then the important part is how do we derive the nexus? So because this amount A is not based on physical presence. It is based on from where revenue is derived. So the nexus, the part of nexus is related to there are thresholds for revenues, and if those thresholds for revenues are crossed, then the group will have nexus in a particular jurisdiction, and there are revenue sourcing rules. The primary rule for revenue sourcing is that where the final product is sold, that will be the uh, that will be the jurisdiction where the revenue will be sourced. And then there's the elimination of double taxation rules, and then there's the tax certainty part, and then there's another block of work is the unilateral measures, which is relating to DST, GST. And then another important part of all this is MDSH. MDSH is marketing and distribution safe harbor. So because now this when this amount A system will be set up, there will be also situations in which there is already residual profit in a market economy. So to avoid this double counting, this mechanism has been introduced and negotiations are going on. And a horizontal work which is related to the administration, because of when all this amount A building blocks are implemented, then there'll be need of how this has to be administered, how the relieving entities are to be identified. So all this are part of the administration. Coming to the second part of the pillar one, the pillar one is amount B. So amount B basically relates to simplification of the existing transfer pricing rules, but it has a scope. And one of the reason why amount B was needed was that if you see if you see amount A deals with the residual part, but then there's an amount which is below the 10%. How do we deal with that? So this amount B deals with the amount below the 10%, and and one of the reasons for the amount we work was that the transfer pricing cases, there are a lot of disputes in transfer pricing cases. And apart from the number of disputes, there's already also problems, especially in developing countries, which is related to the lack of comparables. And a lot of countries even don't have an enabling TP legislation, and there's a lot of capacity building whenever you have the TP legislation. So how do we deal with it? So amount B was brought in to deal with those situations. And amount B is basically of how it has been negotiated is deals with the baseline and marketing and distribution activities. And so amount B benefits in the form of clear scope criteria of which will qualify for amount B. And there'll be a pricing methodology which is under negotiation, and there was a public consultation document that was released, and I've also given the link of the amount B public consultation document in the slide itself. And the main reason of bringing in amount B was that the low capacity jurisdictions have the problem that there are no comparables, and they don't even have access to databases. So there's always dispute on what would be what would be the arm's length price in the absence of comparables. So this amount B. It is a form of it has a form of inbuilt tax tax certainty, in the sense that you prevent disputes before they happen. So amount B is also part of that, and it will also spare a lot of inventory related to transfer pricing cases, especially in the marketing and distribution area, will be cleared once this amount B comes up. And amount B will be something that will how it will be implemented is still under discussion. This was about pillar one, the two components. And now I come to my second part of presentation, which is with a focus on the dispute prevention. So as part of the October statement, in which the broad contours of the two-pillar solution were agreed, it was also agreed that there will be a dispute prevention and resolution mechanism to avoid double taxation for Amount A, including issues relating to Amount A and also for Amount A. So there are two dimensions of this tax certainty mechanism. The first dimension is that related to Amount A, which is part of pillar one, and the second is all the issues which are related to Amount A, which deals with the other part, which is not part of the Amount A, but has a relation with Amount A, which is related to transfer pricing and business profits. And it also proposes, and the countries that are part of the statement have agreed that all this dispute prevention and resolution will be in the form of a mandatory and binding mechanism. So even the fact that whether the dispute is related to Amount A or not will also be solved in the mandatory and binding mechanism. The moment I say mandatory and binding mechanism, the first thing that comes out that probably there'll be an arbitration mechanism. Well, it's not an arbitration mechanism. It's a different mechanism, and that is why one of the trends that I had presented in the first slide was that dispute resolution is going in new innovative ways are being found to how to address the dispute resolution and also of how we can prevent the disputes before they happen. Apart from this, that there is also a special provision for specified low capacity jurisdiction, which is related to an elective and a binding dispute resolution mechanism. So I'll come to it later on. So now coming to the Amount A part. So why did we needed a multilateral mandatory binding dispute prevention mechanism? So if you see that since Amount A, as I had also shown in a diagram, that Amount A is at a global level. So it's at a group level. So once we have this group, it can be operating, say, in 20, 30, and even more than 100 countries. So if there are disputes, how do we solve them? Then if each country starts raising a dispute, starts raising a demand, then it will be just chaotic. Then you really cannot freeze Amount A for a certain year. So since Amount A operates by applying a single set of rules to global revenues and profits of a group, therefore it is needed that we have a single system of how these disputes are resolved. And if we use the traditional tools, it would be unimaginably complex. And that is why a new innovative approach was needed. And just as I said that there are two dimensions of how we can tackle the disputes. So the first part of Amount A is that prevention mechanism is that there are two types of systems. So it's basically developed on a panel mechanism. So and there are two panels. One is the review panel and second is the determination panel. And these panels will be represented by government officials, especially the review panel, where the governments will sit and resolve disputes. So that's the basic mechanism. So it's a representative panel which will have a certain number of jurisdiction representatives. And these panels will not be a standing panel. So these panels will be formed once for each company, there'll be a different composition of panels. So for every company, a panel will be formed. But there'll be different types of panels that will be formed because this mechanism consists of three types of reviews. So first is the scope review. So there are a lot of MNEs which we just want to check whether they fall in scope or not, because because if you see the rules, they are pretty formulaic, they're pretty clear, but still especially given the fact that there are certain extractive part and the regulated financial part is excluded, there can be confusion. So for certainty, there will be MNEs that they want to be part of, they want to take a early certainty in the form of a scope certainty review. So there's a mechanism for the scope certainty review. Then there's a mechanism for the advanced certainty review. This advanced certainty review is to examine the methodology. This is basically to examine what are the methodologies that companies are adopting, whether the methodologies are as per the amount A rules. So these methodologies can relate to areas of revenue sourcing, categorization of revenues, choice of the method that is being adopted by the company for revenue sourcing, and then then all the companies would have an internal control framework for revenue sourcing. So those parts will be checked in the advanced certainty review. And then you have the comprehensive certainty review. So this comprehensive certainty review deals with all part of it. So each company will be expected to file a common documentation package. And in this common documentation package, all the information will be there. So the information will be there that at group level, this is the revenue that is earned from different jurisdictions, and this much amount A will be allocated to these jurisdictions. And then when we have this allocation of amount A, then this has to be also be funded. So the funding will come from some jurisdictions which have those residual profits, and they will provide the relief. So all this will be part of the comprehensive certainty review. So the way these reviews are designed is that all these reviews, like scope certainty review, has a period of 7 years. So for 7 years, that whatever decision will stand until and unless some parts like revenues change or some other conditions of the companies change. Then this advanced certainty review is applicable for 5 years. So whatever if those basic conditions that on the basis of which this advanced certainty review was taken, so if they don't change, then it will be applicable for 5 years. And comprehensive certainty review is on a year by year basis. But this comprehensive certainty review will not take place every time a company applies for this comprehensive certainty review. The first time it applies, it will be done by panels. If it applies for the second time, it will be done by the lead tax administration. But if 5 years have elapsed between one comprehensive review to the other, then again a panel will be formed. So this system that panels will not be formed at on every review was done because otherwise, given the fact that there'll be more than 100 companies in scope, so the whole pipeline will be just filled with all these reviews. Though I do understand one of the questions is in the initial years, the pipeline will be full, and that is why we have different mechanisms. So once we have we have this panel system. So how these panels will operate? So because each panel will have a certain scope of what it will look into it, and once it looks into it, the decision that is reached by these panels will be mandatory and binding, and all the countries would have to agree to whatever the decisions of these panels. So the review panel operates by a consensus method. So in a review panel, there are representatives from countries, and once they agree that this is what is to be done regarding the comprehensive scope, because it's a comprehensive review, so that decision is implemented. But there can be situations in which the review panel does not reach a decision. So in those cases, there's a panel above the review panel, which is called the determination panel. So when there's a determination panel, the review panel will present the choices that are there to the determination panel, and the determination panel will choose from those choices what would be the decision. So the determination panel is not a body which is not a panel which makes an independent opinion decision making, but it operates on the last best offer approach. So there'll be offers in the sense the review panel will present the various options, and out of those options, the determination panel will choose, and the decision is on consensus. But if consensus is not possible, then it will be on the basis of a simple majority. And there can be situations where there are more than two outcomes for an issue, and so then and there's an alternative methodology that is being developed, which is a preference that they will be ranking on the basis of preferences. So all this is still under development, and the last public consultation was carried out on this tax certainty block in October, and now after the feedback from the public consultation, so the negotiations are ongoing to incorporate the develop from the comments from the public, and they are being further refined. And just like I had stated on while discussing the previous slide, that the review panel will be presenting specific questions to the determination panel. So regarding the composition of panels, in the review panel and the determination panel, there'll be around 7 members. And the review panel will consist of entirely of tax officials, which will be chosen through a random selection among those that express the interest. And in every panel, both review panel and determination panel, there'll be a representative from the lead tax administration. So lead tax administration is the administration where the parent entity of the group is based. And the determination panel, which lies above the review panel, will also consist of 7 members. And regarding its composition, still the negotiations are going on. So there are three options that are available. And by these 3 options, because of the support of countries, one is the all government panel, that it should only consist of all government officials. So there are some countries which support the view that it should consist of independent experts, because the review panel already has government officials, and if they are not being able to reach to a consensus, then there should be independent experts. And then there is also a third set of countries which believe that why not we have something which is middle, neither government nor independent, but a mixed panel consisting of both government representatives and of independent experts, so as to have a solution. And while entering this process of early certainty for amount A, a company will have to pay a certain fees. The exact amount is being negotiated, and if there are if independent experts are chosen, then there'll be a cap of remuneration, so that this process is not costly. So that cap is of 1,000 euro per day and maximum up to 5 days. So you can just so that will be 5,000 euro per member, and all this process would involve there'll be no MNE or MNE representative. So it's all this early certainty process is all a government process, because in review panel, whatever application is given by whatever early certainty request is given by the MNE, that will be discussed among the government officials and the MNE, and in case any information is needed, so that can be taken from the MNE. So if there is no consensus, then once it goes to the determination panel, it is the review panel which really gives the choices, and the MNE has no role to play. And now coming to an important part is that since this is a mandatory and binding for the governments, would the MNE is the decision also binding on the taxpayer? So regarding this, so if you see the way the whole system is designed, though there are no constraints, the MNE can reject whatever decision is taken by the review panel or the determination panel. But the very fact that remains that since this is a multilateral mechanism, so MNEs doesn't have an incentive to not to agree, because if it doesn't agree, then it will have to go through all the domestic processes in the different countries, and so it is not in its interest. So so there's an inbuilt incentive for the MNE to agree to whatever decision is taken. So this was the first part. And the second part of the dispute resolution is the tax certainty for issues related to amount. So as part of the public consultation, the various questions that are there were released, because whether it should cover all MAP disputes, and how do we define what is related to amount A, and many countries have an existing mandatory binding mechanism in treaties. How do we do it? So basically how it works is that once you have a map, so after map, in case of in-scope companies and for related issues, if no decision is reached, then a dispute resolution panel will be formed. And this dispute panel will reach to a decision. Again, on those bases, on the last best offer, it means the two countries will present their offers, and out of which the panel will choose the options, and the option that will be chosen will be binding on both the parties. But it also has an added that if the parties feel that they have the choice to deviate, if the two competent authorities reach to a different decision and they agree, both the parties agree. So now the question is that since this operates in a bilateral treaty base on the bilateral treaty basis, what happens when there are no bilateral treaties? So do we have this mechanism? So this is also currently under negotiation. And should we have a materiality threshold to access this mechanism? And what would be the composition of the dispute resolution panel? Again, the three choices that were discussed are currently being discussed. And for certain countries, especially the low capacity countries which have very low MAP levels, say under 10, and they fall under the category of low and middle income as per the World Bank Atlas method. So they can have an elective binding dispute resolution mechanism. So what effectively means that if the two CAs agree that to go ahead with forming a panel, a dispute resolution panel, then that mechanism would be set up. So this is basically about the tax certainty, which is related to which is for amount A, and also issues related to amount A. And now, lastly, I will come to another aspect which I had touched, was that of an intergovernmental body. So last year was a pretty significant year in the sense that on 30th December 2022, the UN Assembly passed a resolution for promotion of an inclusive and effective international tax cooperation at the United Nations. And this basically laid down of the seeds for an intergovernmental discussion at the UN. And the ECOSOC meeting was held on 31st March. And before that, all the countries and anybody, as a matter of fact, all the stakeholders were requested to give their comments, because the Secretary General has to prepare a report which will outline the next steps will be taken in pursuance of this resolution. I have given a link where the member states and other relevant stakeholders have given comments, and they are available in the public domain and anybody can see. And on 31st March, the ECOSOC meeting took place. So they member states and even NGOs and some company representatives and company associations also participated in this, and they made interventions just to give what their view is, and it's not surprising that there are divergent views and opinions of what should there be an intergovernmental tax cooperation framework. Like countries like many developing countries support it. They say that since in all other areas you have a tax, you have a intergovernmental body, now why not in tax area? Because given the fact that multilateralism in tax has increased over the time. And one of the reasons was for not having such an intergovernmental body is that mainly tax is because of DTAs and other things. It was a bilateral, but overall, given the fact the way things have developed, it's become a global issue. So it's something that no country can solve on its own, or two countries or a group of countries. You need all the countries together. So this is the right time for having a discussion. But there are some countries which believe that already you have the inclusive framework, so already negotiations for reallocation of taxing rights and other rules are being taking place. So why do you need? So what do we really need it? Why do we want to duplicate the processes? But there's some countries which also feel that yes, fine, there are there are various there are various multilateral corporations that are taking place at a different level. But why don't we have an overarching body which can really coordinate it? Because apart from, because if you see, one of the reasons is that a lot of times the agenda setting, if you see even in BEPS and BEPS, the agenda setting is more of top to bottom. So the it's wherever there are interests, there wherever certain countries which have more power in terms of more economic power have interests, so they will be ruling, they will be setting up the agenda. So that is how the power structure is. And so a lot of developing countries feel that they are they feel marginalized, that they don't have that say in the whole process. And so there are different views, and it's an important area, it's an important space which is to be washed out of how all this develops. So that's the end of it. I think so. I stuck to my 1 hour limit, and with this, I'll just request that if there are any questions I can answer, it will be a pleasure to answer. But I do understand that this is quite a uh, complex area of work, and with so much happening. So, but I tried to be as simple and basic as possible so that I could do justice to this topic. So over to Sana, and anybody have questions.
Thank you so much, Mr. Rao. This is uh, for, I think, for the students and for us also, a lot of us, this was was a very complicated topic which you explained so well. So thank you so much for that. I have actually received a couple of questions from students who are watching this on the YouTube live. So if you'd like to take their question, I'll just, say it out loud for you, that how effective are APAs when it comes to prevention of disputes, especially seeing that India recently signed a number of APAs.
Yeah, as everybody is aware that that in the last financial year, more than 90 APAs and BAPAs were signed, and APAs and the bilateral APAs are very effective, and they give a lot of certainty. They give tax certainty. They are one of the ways in which India is reaching out to address tax certainty. But again, we should also understand that APAs are one part of the whole picture, where which are a dispute preventive measure and which give tax certainty. But there are a lot of other cogs, like you have the map procedure is there, and then you obviously, and then if amount A comes in, if you have the APAs, probably those countries would not need to enter, not go for tax certainty. But then APAs are not there in all the countries. So you have to sign individual APAs with everybody if you look at amount A. So that is why we have a separate mechanism. But whatever said and done, the APAs are a very important aspect of tax certainty, and they give give the MNEs a certainty for a certain period of time and lead to less litigation and disputes.
Okay. Thank you. Another question that I have is that, do you think India's G20 presidency will have any bearing on the implementation of the two-pillar approach of OECD?
So as you can see that one of the priorities of the Indian G20 presidency is monitoring the two-pillar solution. So if we look at one of on pillar one, so pillar one is presently under negotiation, and India is engaged constructively in those negotiations. And pillar two is more of a common approach, as I had also presented in my slide. So that common approach, so how is India's driving it? So we are focusing on tax capacity building. So that is a very important part, even for pillar one, because what we feel is that countries should be aware what they're signing up for. And as Sana just you said, that it's quite complex. It's no doubt complex. And I had just touched the surface. So once you go deep inside, so it's just like an iceberg. So you just saw a very small portion of it. So they are complex. So, and you need tax certainty. You need to develop the capabilities of countries, because there are 142 countries, and we can't expect every country to have the capacity, because at a lot of times, that if you look at a lot of developing countries, their real focus is to how to deal with the firefighting issues. That is what everybody really is. A lot of tax administrations are concerned, and this comes on the second priority, because they think, yeah. So for all this, you need a lot of capacity building, so that countries can effectively sign up, and they do understand and then implement it, and we can have a solution that is sustainable and also yields meaningful revenue. And India's G20 presidency is playing a role in monitoring it, and also pushing towards tax certainty, and pushing towards the capacity building part also. Thank you.
I think there's just one more question. If you're okay with it, we can take it. Has anti-abuse provisions in every DTA, including multinational conventions, been rendered redundant by the Parliament by virtue of coming in force of Chapter 10A of the IT Act, read with Section 92A of the IT Act? I think this is. Sorry?
Yeah, I have not been able to understand the question, the context of the question, but what I can see, what I can just say is that if you see that the anti-abuse, most of the treaties after the MLI have the principal purpose test, and we have a domestic guard also. So the principal purpose test operates in the treaties, and there's a commentary for it, both in the OECD and in the UN, and there are certain parameters of how that will be implemented. So as I see it, that the anti-abuse measures still stand, and they are there in the treaties, and as and when situation comes, they will be implemented.
Yes, thank you. We actually have a student who wants to ask you a question. Anirudh? No, Drishti. Drishti, you can please unmute yourself and go ahead.
Yes, ma'am. First of all, thank you so much, sir, for doing this guest lecture. It was a really great insight into all of these trending issues in international taxation right now. With regards to the question on India's G20 presidency, having a bearing on the two-pillar approach, like you mentioned, that tax capacity building is something that all of the governments should prioritize. I wanted to ask, what exactly that capacity building will entail? How exactly will it happen?
Yeah, thank you, Dishri. That's a very good question. So I'll just explain you that why tax capacity is important, and how and what is to be done. So if you see I'll just give you a very practical example of what is happening. As you must be aware, that Pillar 2 rules, model rules, and the commentary it's already in public domain, and the administrative guidance is already there. So now when all this is there, the countries would, because being a common approach, countries would have to legislate. So those model rules are there, but then they have to be translated into the language of that country's law. So for that, you need in-depth understanding of how globe rules operate. Similarly, STTR is being negotiated. Once STTR comes into one it is implemented, the countries would need to have a domestic law also, plus a law in the treaty that they can effectively use the subject to tax rule. Similarly, in case of amount A, once the MLC is reached, there'll be a lot of number of domestic changes that have to be done. So once you look at it, you will need handbooks, you will need tutorials, you will need some guidance for, especially for low capacity countries, of how this has to be done, and even for developed countries, because ultimately these rules, once they are negotiated, they have to be translated into the domestic law. And once you do that, you need clear understanding. So as part of our capacity building initiative, we propose to have these handbooks, we propose to have sessions, we propose to have capacity building networks where country delegates can reach out, like ADB is developing a helpline for the globals. Similarly, UK is also taking up the task of developing a network in which they have those experts which can answer to calls of countries. Similarly, OECD as part of its global relation program, is providing assistance to a lot of developing countries of how the QDMTT rule, the domestic legislation, can be legislated. So all this require a lot of outreach. And as part of G20, India is pushing ahead for this capacity building. And if you have a chance, also have the look at the chair summary that was part of the February finance ministers and central bank governors meeting, which was held in Bengaluru. So once you read it, if you will find a line in the tax paragraph which says that all the countries, all the G20 countries and also the invitee countries, delegates, finance ministers agreed that the tax capacity, that coordinated tax capacity building is needed, especially given the fact the way the international taxation trends are going. So thank you for the question, Drishti.
Thank you so much, sir.
Thank you, Drishti. Does anyone else have any other questions? Okay. I think we do not have any more questions, so we can end this session. Thank you so much, Mr. Rao. Thank you so much. This was great. Generally, this is such a complex topic. You've taken us into a lot of, for us, this was a lot of detail also, not just, the basics. So thank you so much.
Thank you. Thank you, Sam. Thank you. Thank you.
Thank you so much, sir. Thank you.
Vinayakji, you can end the live also.
I need to stop sharing. Okay, thank you. Bye-bye.
Bye-bye.
Thank you. Bye.